You'll recall from the recap that an organization or corporation gets into severe financial problems when what they are owed or their assets is significantly less than what they owe or their liabilities. What most companies do is they reorganize or file for bankruptcy. And in this situation, what they do is they try and reconcile their assets and net worth so they're able to pay off their liabilities or what they owe creditors and debtors. But there are cases where even with reorganization bankruptcy, a corporation might not be able to turn and put itself back into the private sector. If a corporation going out of business might have an extreme detrimental effect on the economy as a whole, this is where the government steps in and nationalizes. But what does nationalization mean, and why does it have such unpopular connotations? Well, let's take the case of a broken bank that needs to be rescued by the government. The common misconception that people have when it comes to nationalization is that the government will take a bank and turn it into a government agency, such as the Department of Motor Vehicles. This is often every American's nightmare because dealing with government agencies is oftentimes associated with incompetence or inefficient bureaucracy. This is, however, not the case when it comes to fixing a bank. In reality, whatever government involvement we will be seeing with the banking system is intended to be temporary. The most important thing the government needs to do, as we have shown from the previous podcast, is pump money into banks that really need this cheap capital. But if you give capital, you essentially take a stake in the corporation. And so if the government gives a lot of money to banks, some argue that it couldn't be more than 50%, because if it's greater than this number, then the government would be a majority shareholder, and that means it would have full control in the future direction of a bank. In reality, this 50% is more of an arbitrary number, and it does not necessarily represent some important threshold of how much say a government has with regards to the future of a bank. So it's important not to dwell on this number. But let's look at an extreme case and assume that the government did in fact become a major shareholder or attempted to buy up an entire bank's balance sheet. In this case, the government does become the owner. However, there is a catch. That bad debt from this bank becomes a responsibility of the government and therefore the liability of the U.S. taxpayers. When it came to fixing up broken banks, none of the previous three scenarios have been seriously considered. Instead, in the United States, when a bank is broken, it is more common to use a method known as conservatorship. This is the case where an agency in the government acts as a conservator and is responsible for the finances of the broken entity. Such was the case of Freddie and Fannie, where they were taken over by the FHLA. In the case of banking, it is the Federal Deposit Insurance Corporation that will come in and take over a bank. Under FDIC conservatorship, the conservator looks at the entity and examines its assets and liabilities. They then try and maximize the assets as a means of recouping losses from outstanding liabilities. The problem that we're seeing now is what is called system-level nationalization, where an entire industry, in our case, the banking industry, is in trouble. Since so many banks have failed, the FDIC alone cannot be expected to repair it. Instead, a fix-up of such proportions requires a coordinated and concerted effort from Congress, the Treasury Department, the FDIC, the Federal Reserve, and other government agencies. So, in this case, what exactly is happening? Well, there are three approaches to fixing the banking industry on a larger scale. One, the government recognizes that the banking system is in trouble and therefore institutes some structural changes. This means that if they give banks cheap capital and buy up their toxic assets, they do so with provisions attached. Another approach is for the government to take the bank from the private sector, move it under government domain, pump in cheap capital, and buy toxic assets. Then when the bank is fixed, return it back to the private sector brand new. The third perspective, which many economists argue was the view of the Paulson Plan, and also some say is kind of in the Geithner Plan, is just letting the bank be and pumping cash. Remember, it isn't easy for the government to get actively involved with a bank's business, politically speaking. On one side, you have taxpayers who don't want responsibilities with liabilities, and on the other side, you have bank employees who don't want to feel that their growth in the future could potentially be stifled by the government. So oftentimes, it's very hard to take a hard line against the banks. If the government does offer a plan, they must come to a solution about how to buy toxic assets while providing cheap capital. One idea is called the bad bank solution, which is where a bank with a bunch of subsidiaries essentially puts all their toxic assets in one banking subsidiary, which is dubbed the bad bank, while all the other banking subsidiaries are the good bank. By separating the toxic assets and putting them all with one entity, they are allowing the government to focus on one bank that needs help as opposed to many banks that need support. Another solution is called the guaranteed assets solution, which is essentially where the government will guarantee a certain number of toxic assets. This might be when a larger bank takes over a bank that's on the risk of failing. When this larger bank takes over, it guarantees a certain portion of these toxic assets. The government, which may have played a part in encouraging this takeover for stability reasons, will guarantee the rest. Has the government been bailing out before? Yes, it has given aid to key businesses and industry, with the most recent case of the airline industry in 2001. But the fact of the matter is, nothing in recent history resembles the scale or the complexity of the bailout we are experiencing right now. To review, nationalization shouldn't be perceived as this one-time permanent government takeover. Most forms of nationalization that we're going to see instead consist of government agencies cleaning up a corporation's balance sheet so it can fully function once again in the private sector. Although we have bailed out corporations and industries before, it has not been anything on the scale that we are now seeing.
Coming up, we will learn how to understand aspects of the bailout.
Thanks for watching. To learn more or watch more podcasts, visit www.subprimethemusical.wordpress.com.